Hi, I'm Jonathan Wernick, Global Equity Analyst at Sasfin Wealth, and today I'm going to be unpacking the performance of Sasfin's Global Equity Model. And to help me understand the performance of the model as well as markets in general, I'm joined by Craig Pfeiffer. Hi Craig, thanks for joining me.
Hi Jonathan, thanks very much. Looking forward to chatting about the model again. It seems the quarters come around quite quickly.
Well, they come around every quarter, and once again we've had a positive quarter. So maybe let's just dive straight into it and maybe just tell us what drove the markets this quarter and why did they perform quite well?
Well, I think this is what makes our job so interesting. It wasn't even a quarter of two halves, it was a quarter of thirds, probably demarcated by the months. January was a great month. We started the year thinking that interest rates are going to peak on the back of inflation peaking and falling, and lower interest rates would help boost the markets, and it was a great January. We finished in the green, but then just at the start of February we had those rate hikes coming through as expected. The Fed raised again by 25 basis points, the European Central Bank raised by 50 basis points, so did the Bank of England, but they came out with quite a hard line still on inflation, which got the market thinking that maybe interest rates still have to go up some more, especially when the Fed came out with their dot plot, which is their projections of where they see the peak rate ending up, and it was still a lot higher than where we were. So the markets then kind of got on the back foot, thought, okay, so this isn't going to pan out sooner than we thought or when we thought, and February was a negative month. We gave back some of the gains of Jan, and then come March we had this whole banking crisis sort of unfolding as well, and it was probably foolish to think that there wouldn't be any casualties from this aggressive hiking in interest rates that we've seen. And some of these mid-sized US banks, and the headlines are all there, kind of mismatch their assets and their liabilities. If looking at the bonds which they held, with that massive increase in rates, the value of those bonds kind of was a lot lower than when they bought them, and they had a bit of a hole that they had to fill. So notwithstanding that mismatch of assets and liabilities, a run on a couple of the banks, and that got everybody thinking, well, are all the banks safe? Are we having another global financial crisis? And thankfully that was averted. After the global financial crisis, we saw a lot of restructuring of bank balance sheets, a lot of introspection by the banking sector and the financial authorities, really shoring up banks with more capital, so in a better place to withstand these kind of shocks. But it still kept the market nervous and anxious, and we finished, I think on the S&P we were still slightly positive in March, but it was a bit of a shaky March, a lot of nerves around. So a lot going on just in those 3 months this year.
And maybe just on the banking crisis, or not a crisis, we still don't know what's going to happen, but in terms of that impact on central banks and interest rates, what has it done to that whole process or that whole cycle in your view?
Well, I think that the central banks faced a bit of a dilemma now or are facing another dilemma with their next meetings. Do they continue to look at inflation as the big bugbear and keep pushing up rates, with the risk of destroying any growth that is left in the economy? Or do they say, we need to look after the integrity of the financial system, maybe we shouldn't raise rates anymore? The stance they've taken so far is that inflation is the central story, the central evil that they need to conquer. So still tightening rates, but they've taken away guidance going forward, and I think now a bit more open to rates coming lower as the year goes on. The markets have certainly taken that view, despite the tough talk by central banks that later in the year we'll see at least the Fed cutting rates on the back of slower economies, even going into recession, maybe a modest recession in the US, but definitely slowing growth, and the market's taking that view.
I think that covers the broad strokes of what happened in markets. If we drill down a bit more, maybe into the sectors and specific stocks, as well as the stocks we hold, the fall in rates certainly had an impact on what we call longer duration stocks. They seem to really benefit from the fall in rates, mostly as a function of their profits or their cash flows being further out in future, and they benefit when interest rates fall. So what we really saw during the quarter was the growth stocks, as opposed to the value stocks, really outperform. So you saw specifically the technology stocks, they had a really good quarter. Looking at the stocks we hold, the big tech names such as Amazon, Apple, Microsoft, they had a really good quarter. But the one sector that really did well, semiconductors, and one stock in particular that really did well was Nvidia. Now that stock, I think it was down almost 50% last year. So you've got to give a bit of context to its move. So it was down quite significantly last year. Then this quarter it was up about 90%. So a lot of the gains for this quarter was a recovery from last year. But the one thing we've seen that's really just exploded since its launch last year was ChatGPT. There's been this proliferation of potential, or what could come from ChatGPT. For those that don't know, ChatGPT is basically an AI chatbot, artificial intelligence chatbot. So a user can basically go into their computer and type a question, almost have a conversation with this bot, asking it certain things. But bringing it back to Nvidia, and why has Nvidia really performed well? It's because the models that basically underlie these AI chatbots, they are basically taught or trained using Nvidia's GPUs, and because of that, the demand, or the expected demand for GPUs, is just basically exploded. What people think could happen, which is quite a turnaround from the last quarter. That being said, the technology stocks had a really good quarter. There were some stocks that pulled back, particularly the ones that actually did quite well last year when interest rates were rising, inflation was a big concern. And that cohort was basically your defensive or your low volatility stocks. So your healthcare names, real estate, utilities. It was a bit of a disappointing quarter for them. Maybe you can just go through just briefly some of the companies we hold there, maybe the healthcare names, staples, your thoughts about, yes, underperformed, but just a brief overview on that.
Yes, I think those stocks, typically defensive, as you said, defended the portfolio last year when things were really tough and the market was falling. But maybe just taking a back seat now with all the excitement again of all those tech stocks and the market going up, investors not needing to really look to defensive stocks. I think very broadly that's kind of the story. But also, if we look in our portfolio, United Health, that's one of our major stocks. We've also got Johnson & Johnson in there. Johnson & Johnson undergoing a little bit of a metamorphosis during this year, just spinning out their consumer health business into a separate listing, Kenvue. But those stocks just lost favor, I think, with the sexiness of artificial intelligence, the defense stocks as well. There's been a theme around defense, particularly with Russia invading Ukraine last year. They've certainly been more in the spotlight, and they have done well. But again, just taking a back seat in this last quarter. So Raytheon is in our portfolio, seems to just get to $100 and just doesn't want to go much further than that at the moment. But these are all counters on stocks where we still see good growth potential over the longer term. And we are about the longer term and looking through some of these cycles. The global economy is slowing. Household disposable incomes are falling. With high inflation, you've got lower real incomes as well. So people tend to spend less in that environment. You just don't want to go out there. You're uncertain about where the economy is going, so you don't spend. And stocks like Nestle and Diageo, although you think you might want to drink your troubles away, that's not always the case. So those stocks, those consumer type stocks, also were a bit on the back foot this quarter.
And I mean, it's no surprise, the biggest underperformer, certainly in our portfolio, was Bank of America. Following the banking crisis, you've basically mentioned a couple of what happened and what caused the problems in the sector. We don't need to unpack all of that again, but I think the one thing we should mention is that we don't know what's going to happen. It's hard to say that the crisis has been averted. There could still be, maybe some underwater bombs going off beneath the surface, and the financial plumbing in the monetary system. There could be some issues there we don't know about. But that's just something to be aware of. Specifically in the banking sector, there could be other surprises waiting for us.
Yeah, there could be in commercial real estate as well. Anything that's tied to interest rates, where you've got loans or assets versus liabilities. Anything that's priced on those interest rates, and they have had such a dramatic move that you don't know what kind of fallout is, as you say, bubbling under the surface.
Well, despite the troubles in the banking sector and the performance of Bank of America, we are more tilted towards a quality growth universe, and those type of stocks are generally longer duration in nature and benefited from the fall in rates. So the global equity model actually outperformed our benchmark, the MSCI equity, mostly due to the interest rates falling. But as we segue basically into our outlook and the way forward, I think we were definitely happy with the performance during the month, or the quarter rather. But I think we also have to take a bit of perspective. Yes, interest rates fell and our portfolio did quite well, but we've got to bring ourselves back to our process and how we invest and how we look at things and where our focus really is. And macro factors, they're important. They obviously affect markets, assets, our stocks, but they're very difficult to predict, especially over the long run. You almost need hindsight to predict these factors. So in our process, we try and follow more a fundamental process, a bottom-up process. Maybe you can just take us through some of the things we look at in terms of these quality growth businesses. What's important to us when we try and find these businesses?
I think you're right. We want to invest in stocks as, I think it's a bit of a catchphrase. We're long-term investors, and it's typically what we pull out the bag when the market's going the wrong way. But we are long-term investors. We want to buy those stocks that are going to perform over the longer term through the different cycles. And some stocks, some industries, some sectors are cyclical. So, if you don't sell them when they're at their peak, you just ride it through and you actually don't make anything out of it. But you want to find those stocks that are going to continue to grow their earnings, in a real way, add real economic profits. So that's something that we look for. You want to look for, and you use the term quality. That's quality stocks, that have a good track record of generating, real income, real cash flows above the cost of their capital. So companies, quality companies that give you that ongoing return, and then reinvest in the business and grow it. And that kind of compounding effect, those are the companies that we really look for, with the last little proviso that we want to buy them at the right price. So that comes back to a valuation argument and just looking at the price of the stock versus its intrinsic value, which we measure with different metrics. So I think those things, quality, growth, at the right price, those are the stocks we want to hold for the long term. So we're not going to be frequent traders ever, because we want to hold those stocks over the longer term. We keep a constant eye on them, as we do, because even good companies go bad, and sometimes bad companies can re-engineer themselves and come onto the horizon and find their way back into your universe. So we're always watching the markets, but those are the kind of attributes that we're looking for.
And you mentioned those three attributes, or those three areas: the quality, the growth, and the price, almost like a three-legged stool. If we look at the characteristics of our holdings, they certainly are of quality relative to the benchmark. We can see that by the high returns on capital. We can see the growth rate relative again to our benchmarks. The companies we hold have generally achieved higher growth rates than the benchmark. And if you look at the outlook for growth at the moment, it is quite depressed. I think the various institutions around the world are downgrading their forecast for growth, but I think we're still comfortable that the companies we own are going to grow faster than generally the broader market. The one thing about quality as well, which is often overlooked except during a period of crisis, is the financial stability of the company or its financial position. These companies that have strong balance sheets, they generate sustainable, stable cash flows, they're able to get you through periods of difficulty. Maybe they won't perform as well as they did during prosperous periods, but relative to other companies, they generally stand up better and often come out even stronger after a period of crisis, having reinvested in the business continuously. So those companies with strong financial positions, that's just another element to quality. And then of course, just bringing it back to one of the beginning points you made, this whole story around inflation. Is inflation going to go higher? When is it always going to go down? What is going to be the long run inflation? Are we going to have deflation? We don't know. Again, these macro factors are very difficult to forecast, especially over the longer term. But maybe you can just touch on the importance of quality companies, especially in terms of pricing power during different periods of inflation or deflation.
I think pricing power is one thing that we do test for. We look at companies that have a competitive advantage, that can do things better than their peers, or have some way to expand their margins because they can. They're a loner in an industry, or they are the best in their industry by some way. So we test for that competitive advantage as well, and throw that into the mix and on top of the three-legged stool as well, and make sure that those companies, either their competitive advantage or their moat, as we call it, is secure or even improving or growing. So that is an additional kind of attribute that we're looking for in these companies.
And those moats often stem from a company having a strong brand, or it's got some kind of cost advantage over its peers. Generally, the companies we hold have very strong brands, or they have these scale advantages. So I think our companies are well positioned to basically deal with whatever inflationary environment we're going to face going forward.
Yes, and I think we also look at these stocks and make sure that they comply, if that's the right word, with those requirements, that they meet those requirements all the time. Circumstances change, economies do different things, technology changes. Your advantage today might look to be good, but down the line, a chat GPT comes up and your little model or whatever it is defunct. So the world does constantly change. So we've got to keep attuned to that and continue to look at our stocks and make sure that they continue to meet those requirements for us. So I think going forward, there's probably a few tweaks that we'll be looking to do to the model in the months and quarters ahead, as we continue to test those attributes on our portfolio.
That's great, Craig. I think we can leave it at there. We've covered a lot today, but we covered the broad strokes of what's happened and how we've performed. So thanks, Craig. Thanks for joining us.
Thanks very much, Jonathan.
And thank you for listening. Keep well.